value traps. At some point, I can almost guarantee if you've been picking individual stocks, you've got involved in a value trap at some point. A stock that seemed really cheap and maybe even kept dropping and still seemed really cheap. The share price just keeps going down. It seems really good, and then eventually the fundamentals deteriorate. You lose the majority of your investment, and maybe even the company goes bankrupt. Well, I'm going to show you how you can avoid value traps and easily spot them by understanding one simple concept. And I'm going to go over how you could have spotted a value trap like Bed Bath & Beyond, and of current value trap, in my opinion, Nordstrom's, ticker JWN, and the telltale signs, just using this one simple concept. So this one simple concept is the business life cycle. So this is a very simple chart showing it. And the two key things we need to focus on here is the sales and the profit. And the key thing to understand is when you start hitting that stage of a business of when you're a value trap, your sales still may be going up. Well, your profits start to flatten and deteriorate. And this, for example, happens a lot in retail stores, which is why I'm using Bed Bath & Beyond and Nordstrom's, because they can hide this in very simple ways by keeping their sales going up, by growing more stores, so the revenue keeps going up. The stores are making less money and therefore less profits. And they can even make it look like their profits are increasing by buying back shares, but at the end of the day, a lot of these stocks do go bankrupt and they do end up being very bad investments. So if we look at the chart at Bed Bath & Beyond here, it used to trade over $75 a share, and this was back in 2015. And I can almost guarantee if you were looking at the stock back then, you may have thought it was a really, really good value. For example, let's just pop up the PE, since a lot of investors like buying low PE stocks. And you can see even in 2015 here, at the very peak, it was a 15 PE. Then in 2016, it's dropping to under a 10 PE. And then a 5.8 PE. And this looked like a good deal. They may have still been profitable, still making money, still buying back shares, but the company was going bankrupt. And we can see this very simply just by looking at these two concepts in the financials. So the first one is the revenue. And we can see basically in 2015, where the peak of the stock is, the revenue actually kept creeping up a little bit by little bit by little bit each year. But this is because they're actually just trying to expand more stores. But if you look at the two underlying margins, the gross margin and the operating margin, we can see the gross margin was already in decline, meaning they were losing their competitive edge and they're having to mark down their goods more to stay competitive. And this went from 40, and you can see every year was ticking down and down and down. So even before the peak, we were starting to see the early signs of it, especially in 2016, 2017, 2018, and now it's got really bad to the point where they're losing money. And we can even see this more obviously in the operating margin. You just look at this. Back in 2008, 2009, 2010, during the whole Great Recession times, their operating margin was at lowest 9.35 and up to 12.5. They got a little bit higher by 2012, 2013, they're at 15, then it goes 14, 13, 11.6, 9.2, 6.16. It's a very fast, steady deterioration. So when we combine these concepts together, we can see this as a value trap. They also happen to be taking on a little bit more interest expense, but a lot of investors will fall for this because if you look at the EPS, they can make it look like their EPS is doing a lot better than it actually is by basically just buying back shares with their profit or even taking more debt to do this. And you can see here their net income was just over $1 billion, and it starts to decline in 2014. By 2015, which was the peak, we've actually had quite a big decline in net income from $1,038 million to $957 million. Well, the whole time during this, the EPS is increasing, making it look like the company is growing. Even in 2016, there was a slight pickup in EPS, while their net income again dropped almost over $100 million. And remember this chart here? Well, all this data we just looked at, all these numbers we just looked at, we can just look at the chart and actually see exactly this happening here. So let's just pop up the revenue. Let's get rid of the stock price because stock price is irrelevant in looking at this concept here. And let's get the profit. So we can, bring up the gross profit Or one of the ones that kind of strip out a lot of other parts of it is we actually look at the EBITDA. I know a lot of value investors don't like EBITDA, but it actually has a very useful use for looking at this concept. So I actually quite like EBITDA a lot to look at stocks from this perspective. And what do we see here? We see exactly what we start seeing in this chart here. The revenue is still ticking up in the 2018, but what's happening? Our gross profit, it's starting to peak here, flatten out and decline. Our EBITDA is peaking and declining. Classic value trap. And they didn't do a good turnaround, so they went bankrupt. You can invest in these companies and find them for turnarounds, but in my opinion, you need extremely deep, value margins basically to take on this risk. I really usually want a really low price to book value, which you typically aren't going to see in a lot of these companies because they end up buying back their shares and destroying all the value rather than actually just paying it out as a dividend. So now let's look at Nordstrom's and see this exact same concept in play. So let's just take a glance at the stock price, and what do we see? Very similar to Bed Bath & Beyond. They peaked in 2015, again, a similar price actually, oddly enough, at $77, and they've been kind of in decline with bounces. It looks like, oh, they're coming back, but they just go down and down, just making new low after new low after new low. And let's also look at the price to earnings ratio, because I'm pretty sure a lot of people have been investing in the stock and it's been looking cheap the whole way going down. So this last year makes it a little bit harder to look when they had the pandemic and there was losses, but you can see even right now they're just at about a 10 PE. In 2019 they're at 11, a 10, a 14, a 19, and 18 going back in 2018. It's getting in these years here, it does not look too expensive, and even now it may drop more in price and it still may be profitable, making it look like a really good value, but in reality I think this is going to be a value trap. So let's pop over the financials here and let's look at these basically concepts again. So what do we have here? We basically have, again, the revenue. The revenue is going up. And again, remember we peaked stock price in 2015, and the revenue actually keeps ticking up because they still were kind of opening stores a little bit, or at least maintaining up, 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 up. It's only during the pandemic they actually got a hit, and that's because of whatever, but they're almost back to what they were before. But again, what do we see in the gross margin and the operating margin? We see this same deterioration. There's not as much in the gross margin, meaning that Nordstrom's isn't having to mark down their prices as much, but they're opening more stores and they're selling less, because we can see this deterioration in the operating margin. Even during the pandemic here, they were still maintaining the Great Recession 2008 to 2010, they're maintaining around a 10% gross margin, got up to 11. And then in 2015, okay, we a little bit under a 10 there, not too bad, but then 2016, oof, 7.63, 6.79. And we see this very rapid deterioration in the gross margin, already down to a 3%. So unless there's a very fundamental shift in their business, I would say Nordstrom's is very likely to go bankrupt in a similar fashion as Bed Bath & Beyond, with people thinking it's a good value play the whole way along. Because again, what's also happening with the net income and the EPS, the same tricks are going on as always. The net income basically peaked in 2013 and starts sliding down very slowly. But during this time, what's happening again? Your EPS is going up. And even though it starts to decline actually in 2016, 2017, it's declining at a smaller pace than the net income because they're buying back shares, reducing that share count along the way. So this has a lot of the factors. Value traps have what value investors do, but I can guarantee you 99% of the people out there on YouTube lands don't understand how to spot a value trap. So let's go and look at the chart to see this exact same business life cycle concept again, because even without looking at the financials, if we just look at a chart of the revenue and EBITDA, we can actually see this again and again, and makes it very, very easy to spot these value traps. Okay, so let's get rid of the price, EBITDA, pop it in there, and what do we see? Revenue's ticking up, and we see the EBITDA peaking off in 2014, 2015, and declining. So I hope this video has brought a lot of value to you. It's a very, I think, simple concept. Most people, if you now understand it, are going to be able to apply this and use it to help spot value traps, or potentially, even if it's not a value trap, it's going to reconsider if the stock and how much risk you want to take and what value you should actually pay for it. So this hopefully will let you steer away from a lot of bad investments and only focus on the good. Although again, this is not, you know, personalized financial advice or anything. This is for educational purposes only, and hopefully entertainment. Maybe you're entertained. So I hope you like, share, and subscribe to the video and my channel, and I'll see you in the next video for more educational stuff about stocks.